to promoting economic growth through the elimination of unnecessary regulatory burdens, a hallmark of the Trump administration. Since assuming the presidency just over a year ago, President Trump has built on this critical work that he achieved in his first administration to make further progress in rolling back overly burdensome regulations that stifle innovation in our economic growth. These efforts go beyond reducing just regulatory red tape. They're about fostering an environment where financial institutions can thrive and contribute to the stability and growth of our economy. I'd be remiss if I didn't remind everyone in the room today of the doom and gloom economic predictions that we heard across the aisle as the Trump administration was sworn in. In late 2024, Moody's Analytics anticipated that a Republican-controlled government would bring 3.5% inflation, 5% unemployment, a recession, and a budget deficit of 6% of GDP. Since then, Democrats have repeatedly and wrongfully accused Republicans of, quote, tanking the economy, close quote. With most of the official data in the books, these warnings missed the mark by a mile. Inflation came in at nearly 1 percentage point lower than that forecast. The unemployment rate never increased beyond 4.5%. No recession materialized, and GDP is on track to have 3 consecutive quarters above 3% growth. Meanwhile, the budget deficit is on track to fall to some 5.4% of the GDP. These numbers speak for themselves. Under President Trump's leadership and Treasury Secretary Bessent's steady hand, the economy is back on track, reversing the damage of the previous administration. Throughout the 119th Congress and committee Republicans remain steadfast in our goal of reinvigorating the commercial banking system and make life more affordable for our American families. That commitment is why I introduced the Main Street Capital Access Act with Subcommittee of Financial Institutions Chair Andy Barr last month. Our community banking package is designed to revitalize local bank formation, right-size regulations that are intended for far larger and more complex institutions, ensure that community lenders can focus on serving our families, small businesses, and our local economies. This bill also aligns with the administration's efforts to right-size regulation and reflects the committee Republicans' dedication to ensuring that financial operations focus on safety and soundness with a tailored approach to supervisory complexity. Similarly, our bipartisan Housing for the 21st Century Act addresses housing affordability head-on by reducing the burdens that have made homes and apartment construction untenable. Improving affordability requires directly expanding the housing supply. Paired with Main Street Capital Access, Americans will benefit from more homes and more affordable ways to finance them. We're grateful for your time today, Mr. Secretary. We look forward to the discussion, and I yield back the balance of my time. I now recognize the ranking member of the committee, Mrs. Waters of California, for a 4-minute opening statement.
Thank you very much, Mr. Chairman. Last week, Donald Trump marked his first year in office with consumer confidence plummeting to a 12-year low. That is not a coincidence. Trump promised a so-called golden age, but apparently he only meant one for his family and billionaire friends. Instead of helping families, Trump's trade wars are driving up the price of goods like groceries, clothing, and furniture. Small businesses and farmers feel it too, and we all know exactly who is to blame. Instead of lowering costs, Donald Trump has doubled down on chaos and cruelty while handing more power and more freedom to Wall Street. For example, instead of directing the Financial Stability Oversight Council to address threats to our economy, Mr. Secretary, it appears that using it to do the exact opposite and deregulate Wall Street. While Trump claimed he wants to cap credit card interest rates, his administration has repealed rules that curbed excessive credit card late fees and shuttered the Consumer Financial Protection Bureau, the very agency that returned $21 billion to Americans after they were ripped off. In fact, Trump's team has dismissed enforcement actions against predatory firms, even after they admitted to defrauding consumers. Why? Could it be because they gave to Trump's campaign or brought his crypto coins? Or could it be this president is not on the side of the American consumer and never has been? It does not stop there. Right now, Trump's Justice Department is conducting a baseless criminal investigation into Jerome Powell to bully the Federal Reserve so they serve Trump's agenda instead of the American people. Since Trump returned to office, Republicans have looked the other way while consumer protections were gutted. Instead of offering solutions to help families, they have protected corporate profits. Under this administration, billionaires are winning and hardworking Americans are losing. We've seen this movie before. The same blind loyalty and deregulation led directly to the 2008 financial crisis when millions of Americans lost their jobs, their homes, and their savings, all while Wall Street walked away with bonuses. Despite repeated demands from Democrats for accountability, Republicans have refused to bring other key administration officials before Congress. That includes CFPB Acting Director Russell Vought, who must be held accountable for dismantling the CFPB. This includes FHA Director and Bill Pulte, who has unlawfully installed himself and his staff on the board of Fannie and Freddie, weaponized mortgage data to try to attack Trump's political enemies, and who is incompetently pushing just plain dumb housing policies like a 50-year mortgage. Every turn, committee, Democrats, and I are standing up for America's consumers, defending strong safeguards, fighting corporate abuse, and the corruption of the Trump family. It's just common sense. Our economy should work for everyone, not just for Trump, that billionaire circles that he's involved with. Republicans need to stand up to Trump, defend our regulators, protect consumers, and put families ahead of Wall Street. Anything less is complicity.
The gentlewoman's time has expired.
I yield back.
I recognize the chair of our subcommittee on financial institutions, Mr. Barr of Kentucky, for a 1-minute opening statement.
Thank you, Mr. Chairman. Secretary Bessent, welcome back to the committee. Under your leadership, FSOC has done a terrific job eliminating unnecessary regulatory burdens and promote economic growth. Common sense legislation like the Main Street Capital Access Act is exactly the type of pro-growth proposal to promote financial stability that FSOC highlighted in its annual report. I'm proud to sponsor the TIER Act and the Community Bank Regulatory Tailoring Act that will modernize outdated statutory thresholds that impose disproportionate regulatory burdens on our financial system. This committee, along with FSOC, can successfully support our community lenders and allow them to thrive under right-sized regulation with this legislation in place. Regulatory tailoring helps to protect the diversity of our financial system, which is itself key to promoting financial stability. I look forward to working with the Treasury Department as you implement my outbound investment legislation that the president signed into law in December. With you at the reins, FSOC has returned to its core values and away from the weaponization and disarray we experienced under the Biden administration. I yield back.
Gentleman yields back. I recognize the ranking member of our subcommittee of financial institutions, Dr. Bill Foster of Illinois, for a 1-minute opening statement.
Thank you, Chair Hill. Mark Twain is credited with observing that history does not repeat, but often rhymes. And those of us who served on this committee during the financial crisis recognize this poem and its tragic ending. We have once again a historically unpopular president, fixated on the glory of his overseas misadventures and foreign bailouts. We have once again a multi-trillion-dollar asset bubble underpinned by opaque and conflicted financial mechanisms that nobody understands by design, being willfully ignored by partisan financial deregulators. And we have families all over America who, despite all the happy talk from the president, are having a hard time paying their mortgages and their monthly bills. You can hardly open any financial news source without seeing a discussion of the pending collapse of the AI circular investment bubble. And that is why we created the FSOC. And that is why last November, Democrats on this committee sent you a letter as chair of FSOC to figure out what we'll have to do when the music stops. Your response was insufficient, dismissive, and dangerous to our economy. I look forward to hearing more from our questions and yield back.
Gentleman yields back. Today, we welcome the testimony of the Honorable Scott Bessent, Secretary of the Department of Treasury and Chair of the Financial Stability Oversight Council. Secretary Bessent, we thank you for taking time to join us today. You'll be recognized for 5 minutes to give an oral presentation of your written testimony. And without objection, your written statement will be made part of the record. Mr. Secretary, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for inviting me to discuss the Financial Stability Oversight Council's 2025 annual report. This report is a culmination of extensive collaboration amongst FSOC members. I'd like to thank them for their hard work and dedication in advancing the President's bold vision for a better America. Since day one, President Trump has focused on building parallel prosperity, an era of economic expansion where Wall Street and Main Street can grow together. To that end, Treasury has tirelessly pursued pro-growth policies to unlock the potential available to all Americans when they are free to save, invest, build businesses, and drive their own economic destinies. The Financial Stability Oversight Council plays an important role in delivering on this agenda. Too often in the past, we've seen regulation by reflex. Rather than preempting crises, regulators have frequently reacted to them after the fact. They've played the role of a hazmat cleanup team instead of preventing dangerous spillovers in the first place. Regulation by reflex has led to a regulatory myopia that has undermined safety and soundness. Under President Biden, the bank regulators preoccupied themselves with reputation risk, climate-related financial risk, and other risks with no clear nexus to safety and soundness. At the same time, they centered supervision on management and other governance matters that distracted examiners and banks' risk managers from the real risk to safety and soundness. The result, predictably, was the second, third, and fourth largest bank failures in U.S. history in 2023. Besides undermining safety and soundness, regulation by reflex has driven excessive regulation. That can lead to economic stagnation, and economic stagnation is itself a grave threat to financial stability. In calibrating regulations, federal agencies must avoid the temptation to create a zero-risk financial system, which would result in what others have called the stability of the graveyard. FSOC should aim to identify vulnerabilities that could lead to systemic crises and encourage the private sector to mitigate those risks before recommending additional regulation. FSOC should also work with its members to support efforts to avoid or pare back existing regulation that stifles pro-growth lending, capital formation, and innovation. And the best way to achieve these goals is by centering economic growth and economic security at the heart of FSOC's agenda. Promoting economic growth and economic security is essential to ensuring financial stability. Economic growth strengthens household, business, and financial institution balance sheets, creating capital buffers that reduce the risk of defaults and financial stress. And economic security reinforces domestic production capacity, raising living standards while reducing vulnerability to external shocks and supply chain disruptions. FSOC's annual report prioritizes economic growth and economic security accordingly, with a specific focus on 4 policy areas: treasury markets, cybersecurity, regulatory modernization, and AI. First, the Council is ensuring that the U.S. Treasury market remains the deepest and most liquid in the world. The Council is supporting efforts by member agencies to strengthen this market against future shocks, including through the Interagency Working Group on Treasury Market Surveillance and the Market Resilience Working Group. Ongoing monitoring and targeted reforms by individual agencies remain essential to financial stability. Second, the Council is taking action to protect our financial system from increasingly sophisticated cyber attacks. Nation-state actors and criminal groups continue to target our financial institutions and infrastructure. To address this risk, the Council is supporting expanded information sharing, joint monitoring, and scenario-based exercises, and it is emphasizing the need for regulated firms to manage cyber risk tied to third-party service providers. Third, the Council is committed to supporting efforts to modernize supervisory and regulatory frameworks for banks and credit unions. Going forward, regulation and supervision should address material risk, enhance transparency, and reduce unnecessary burdens, particularly for small and community banks. Fourth, The council is prioritizing the responsible use of artificial intelligence to strengthen financial stability. The council is working with public and private partners, including international counterparts, to enhance system resilience while closely monitoring emerging risks. I will close by highlighting our progress in enhancing the utility of our annual report. In this year's report, FSOC shifted away from its past approach, where nearly every major market and financial sector was described as a financial stability vulnerability. By introducing a new structure centered on fostering economic growth and security, we're tuning out the noise to concentrate on the issues that matter most for U.S. financial stability. With this overview, I look forward to taking your questions.
Well, now, thank the Secretary, and we will turn to member questions, and I recognize myself for 5 minutes for questions. You made a persuasive case that since President Trump was sworn in, that economic growth is a cornerstone of his presidency, and you highlighted today, as you have in speeches over the year, the importance of that Wall Street's doing well, but it's Main Street's turn, and you'd like to see economic growth expanded into what I always quote from Steve Case, the rise of the rest, where we see that economic performance expand across the country. We share that commitment here on this committee by reversing elements of the regulatory framework that have sought, possibly certainly well-intentioned, the concept of too big to fail, but ended up in creating an environment over the past 15 years where community banks are too small to succeed, or maybe avoiding your term today you chose to use, the stability of the graveyard. The committee has worked together on a bipartisan basis to highlight some of the principal actions that we've considered over the past year. Our Main Street Capital Access Act, which we intend to bring to the House floor. We're grateful for your Undersecretary, Mr. McKernan, who last month joined us as we rolled out that package to talk about how we can collaborate. Would you take a minute and from your perspective, how do strong, well-capitalized community banks and the benefits of tailoring that are in this legislative proposal help accomplish faster economic growth and the rise of the rest?
Chairman Hill, as I've said, it's Main Street's turn, and essential for Main Street's having its turn are the small and community banks. And I would note that thanks to onerous regulation, and as you and I both say, community and small banks became too small to succeed. Tragically, more than 50% of our community banks have disappeared since the great financial crisis, not during, since. There have been virtually no de novo banks created, whereas before the GFC, there were more than 50 per year. And small and community banks not only are the anchor for community-based lending, but they provide the bulk of lending for agriculture, for small real estate loans, and for small business loans. So a thriving community bank infrastructure and ecosystem is essential. I've met with more individually and in roundtables with more than 200 community bankers. I've spoken at conferences with more than 1,000, and tailoring is essential. I had one banker from my home state in South Carolina with assets of about $200 million tell me that under the previous regulatory regime, she was told that she should be more like Bank America, the second largest bank in the country. And so it is essential that we have the right tailoring, right risk levels, and right monitoring of these important institutions.
We thank you for your perspective on that, and to illustrate it in our work we've done on housing in the committee, also on a bipartisan basis, it was noted that banks under $10 billion in size, really the heart of our community banking system, several thousand banks across the country, they make 60% of our 1 to 4 family construction loans. And while banks of all sizes deliver amazing capital access in our economy, at the heart of our Main Streets, if we want more housing supply, we find that it's really that local grassroots, public or privately held community bank that helps lead that. You mentioned de novos, and under Chairman Barr's leadership in our subcommittee, and on, again, with bipartisan support, we've enhanced in the Main Street Capital Access Act ways we think that will speed up and make easier to get both deposit insurance, raise capital, and tell the story about having more dynamic de novo bank formations that, as you say, have been so slowed by the last 15 years. Turning to digital assets, something that we've talked about quite a bit in the time remaining, can you tell me your assessment of how the regulatory process is coming for the implementation of the GENIUS Act?
The GENIUS Act was an important act, important piece of legislation for bringing back into the U.S. the regulation, creation of digital assets, and making the United States a national champion. The GENIUS Act and the stable coins that will be created with that could in fact be an important feature of financing the U.S. government. And we are moving with deliberate speed to round out the House and the Senate's intention on that important,
Thank you very much, Mr. Secretary.
piece of legislation.
Appreciate your work and leadership there. I now recognize the ranking member of our committee, Mrs. Waters of California, for 5 minutes for questions.
Thank you very much, Secretary Bessent. In the FSOC annual report, you stressed the importance of economic growth to promote financial stability. While you noted many ways you plan to deregulate Wall Street and plant the seeds for another crisis, you said little about the harms of inflation. I find this odd as the president and you have finally began discussing in the media how the price of goods are way too high. Notably, you mentioned that tariffs may need to come down to lower costs for Americans. So I have a few questions about this. As a former hedge fund manager in 2004, and I don't want you to go into any long details about this, but did you write a letter to investors raising concerns about the impact of tariffs, writing that, quote, tariffs are inflationary? Did you say that at that time, yes or no?
No.
Okay, thank you. Okay, we have a New York Times article that, agrees that
New
you said
York
that.
Times.
Then last summer, when you testified before a Senate committee, you said, and I quote, "There is no inflation. Tariffs are not being passed on to consumers." You were quite definitive and even claimed that critics had, quote, tariff derangement syndrome. Well, those comments are at odds with the statement you made to investors that tariffs are inflationary. Again, I want to be clear, so just let me ask you, are tariffs inflationary? Yes or no?
According to the San Francisco Federal Reserve, with 150 years of data,
Yes or no?
tariffs do not cause inflation. San Francisco Federal
Well,
Reserve.
last November, as the
Congresswoman,
Trump administration finally began to realize
150 years
that
of data.
affordability issues in America are not a hoax. You told Fox News that the government was going to reduce tariffs on goods like coffee and bananas, and that doing so would, quote, bring the prices down very quickly. Mr. Secretary, why was that announcement even necessary? If tariffs aren't inflationary, and as you and the president like to say, are paid for by the foreign country, a tariff on coffee or bananas shouldn't raise the price of either for American consumers. Well, that's the Trump logic, but that isn't reality. It did raise prices across the board. And you know it. I think you knew back in July also. The real question is, why would you even impose a tariff on a good that a country doesn't grow or make, as that would only serve to punish the American consumer? Now, as you know, this committee has taken a bipartisan approach to addressing another real affordability crisis. Housing. Rents are too high. There aren't enough houses. However, one clear reason that the housing crisis has grown worse is that you and the rest of the Trump administration levied tariffs on housing production goods like lumber and steel, as well as appliances. These tariffs will result in half.
Lumber is
Reclaiming my time. You don't get to talk.
Lumber is at a
Reclaiming my
5-year
time.
low, Congresswoman.
Reclaiming my time.
Let's just have the facts.
Reclaiming my time. Thank you. However, one clear reason that the housing crisis has gone worse is that you and the rest of the Trump administration levied tariffs on housing production goods like lumber and steel, as I said, as well as appliances. These tariffs will result in 500,000 fewer homes built at a time when we need more homes built, not less. Trump single-handedly made housing more expensive. And once again, you know it, as Axios has reported that you were planning to lift tariffs on housing production goods. In addition, the unlawful campaign the Trump administration has waged with ICE and Border Patrol terrorizing American communities has also harmed home construction across America. So I ask you, Secretary Bessent, will you be the voice of reason in the administration and urge Trump to stop waging a war on American consumers and on housing or affordability and putting the economy at risk? Yes or no? You don't have to explain.
Representative
Will you be the voice?
Will
you be the voice? Will you be the voice?
Of inflation?
Will you be the voice of reason? Will you be the voice of reason?
A study
Yes or
from
no?
Wharton University
Reclaiming my
has
time.
shown
Reclaiming my time. Reclaiming my time.
was the mass
Reclaiming my
unfettered
time.
immigration
Mr. Chair, will you
let
let
in
him
between
know
10
that
and
when I
20
ask
million
him to
immigrants.
Time does
took
belong
up
to
the housing
gentlewoman
stock.
from California.
10 and 20 million immigrants
Can you
took
shut
up the
him up?
housing stock
Oh,
of working Americans. And can you maintain some level of dignity?
Gentleman's time has expired.
No, my time has not expired.
Your time has expired. The
The
gentleman,
gentleman took up my time. I think you should recognize that, Mr. Chair.
the gentlewoman's
He took
time
up
has
my time.
expired. The gentlewoman's time has
Well,
expired.
if you
Mr.
wanna
Chair,
put-
parliamentary
If you
inquiry.
wanna
Chair,
protect him,
the chair
Mr.
recognizes the vice chairman of the
Mr.
committee,
Chair.
Mr.
If you
Heisinger.
want to
Parliamentary inquiry.
go right ahead, but I would not expect you to do that.
Thank you, Mr. Chairman. And I will grant very briefly anytime that you feel like you need to address anything.
Again, I think the ranking member does not understand. that.
Mr. Secretary, I'm sorry. The gentleman will suspend. There's a parliamentary inquiry. Mr. Sherman?
Mr. Chair, will you enforce the rules of this committee so that the time belongs to the questioner and prevent filibusters from taking time away? And if those filibusters by the witness do take time away, will you allocate additional time?
I will enforce the 5-minute rule. The
I
gentleman
want my
from-
time back.
The gentleman from Michigan is recognized.
I grant briefly anything that you feel you need to address.
I believe the ranking member does not understand the definition of generalized inflation versus one-time price increases. I would also note that housing, especially for working Americans, a Wharton study has shown that the mass unfettered immigration, adding 10 to 20 million new people demanding housing, Congresswoman, is what caused a great deal of housing inflation for working Americans. So you and the Biden administration should be ashamed.
Which is also why we are seeing rents. There was just a recent media story on this. Rents are going down partially because of that enforcement. So Mr. Secretary.
Yes, it is supply and demand continues to work.
I've got a number of issues I got to hit very briefly here on FSOC. I need to talk then Burma and 3%. You talked about with the chairman about regulators using tailored market approach tools. How are you ensuring that FSOC's current work continues to prioritize activity-based, transparent, analytically rigorous approach grounded in cost-benefit analysis and coordination with functional regulators when evaluating potential risks in non-bank financial markets?
That is done primarily for small banks through the Office of the Controller of the Currency and the FDIC. And those chairs are intent on tailoring the rules for small banks so that we do not have another 50% decrease in Main Street lending.
All right, thank you. You outlined as part of the 4 goals, protecting, number 2 was protecting from cyber attacks. We have seen a rise in those cyber attacks in scam centers in Burma. And I applaud you and Treasury for some of your work in that, including sanctioning North Korean individuals selling weapons to the Burmese military regime, as well as the Democratic Korean Benevolent Army, Burmese army group that has organized these scam centers. However, last week it was reported that Iran was secretly shipping vast amounts of jet fuel in Burma. I need to move through this quickly here, but that's why last year I introduced a bipartisan legislation that would specifically require the president to determine whether to impose stronger blocking sanctions on Myanmar oil and gas, Myanmar Economic Bank, and foreign persons operating in the jet fuel sector of the Burmese economy. I read recently that Treasury responded to Reuters' report by noting that Iran's quest for, quote, new markets is a sign that President Trump's policies are working, which I would agree. I'm also aware that Burma's military leaders have attempted to gain favor with the president, especially when it comes to lowering tariffs levied on his country. This is something that simply cannot happen. I represent a significant Rohingya population and know that the active bombing that is going on is unacceptable. And I believe we must continue to impose strict sanctions on the Burmese military rulers. What tools can Treasury use to punish both Iran and Burma for violating both U.S. and other Western country sanctions?
Well, with respect to Iran, President Trump, upon entering office, instructed U.S. Treasury to implement a maximum pressure campaign. And we saw the fruits of that campaign in December as the Iranian economy has collapsed. Yeah. We had a large bank collapse there. The central bank was forced to bail it out, created inflation, and the brave Iranian people have taken to the streets. We continuously monitor trade between two countries like that. The good news would be Iran has a significant shortage of dollars to buy, whether it is weapons or goods for the people, or to pad the Swiss bank accounts of the Iranian regime.
We've got to keep the pressure up on Iran, but also that pressure on the Burmese junta, please. Lastly, I'd be remiss if I did not thank you in public for your discussion of a desire to lower the deficits to 3% of the GDP. I've introduced, along with 14 of my colleagues from the Bipartisan Fiscal Forum that I chair with Congressman Scott Peters out of California, that urges the House to achieve this 3% goal by 2030, a tangible, achievable goal that is desperately needed. And we're building consensus here in the House. I know you and the administration take the ticking debt bomb seriously, and I hope that to continue this conversation with you. I don't know if you can, in 10 seconds,
I look
address
forward to working with you on that. And I would note that the deficit to GDP calendar year 2024, 7%, highest, not at war, not in a recession. Calendar 2025 down to 5.4%.
I yield back. Thank you.
Chair recognizes the gentleman from California, our ranking member of our Capital Markets Subcommittee. Mr. Sherman, you're recognized for 5 minutes.
I want to agree with the gentleman from Michigan that we need to impose those sanctions on the Myanmar regime and protect, of course, the Rohingya minority to the extent we can. The FSOC has to define what is systemic. I, for one, think that we shouldn't be focusing on the assets, but rather the liabilities. We didn't have a problem in 2008 because the banks had too many assets. We had a problem because they had too many liabilities. So I don't see how most—
Congressman, that's incorrect. Ben Bernanke, then Fed chair, said, could you please tell me what these assets are?
I'm going to reclaim my time. Regardless of that, I'm going to ask you whether you, not going to ask you to agree with me. I'm going to ask you to agree with your predecessor, Secretary Mnuchin. During the first Trump administration, Secretary Mnuchin promulgated interpretive guidance that prioritized an activities-based approach to systemic risk regulation over an entity approach. Secretary Bessent, you have indicated that you want to kick off a review of FSOC's activities and processes. The FSOC Improvement Act, led by my colleague, Dr. Foster, which I've co-sponsored, as you know, would codify an activities-based approach to systemic risk regulation. Does the FSOC plan to revert to the 2019 guidance of the first Trump administration regarding a definition of a SIFI?
Yes, we prefer an activities-based approach rather than an institutional-based approach.
Thank you. I want to pick up on the ranking member's comments about whether tariffs cause inflation. You know, economists can say when the price of something goes up by 20%, that isn't inflation. It's a one-time price increase. But out in my district, when the price of something goes up by 20%, we call that unaffordability. And to say it's not inflation is sophistry. I'll point out that every time Democrats had and regulations that increased a company's cost, people in this room said that's going to cause inflation. Well, tariffs clearly have to be paid by companies. And if environmental costs are passed through, you can be sure tariffs are passed through. The ranking member asked the question, why a tariff on coffee and bananas? I think the answer is obvious: to make our tax system more regressive, to pay for the big, bad, beautiful bills, cuts in taxes for billionaires, and to fund ICE. I used to head the largest sales tax agency in this country, and we knew the sales tax was regressive, but we knew it would be even more regressive if we imposed sales taxes on food. And that is what you do with a tariff on bananas and coffee. Mr. Secretary, we lived through the bailouts of 2008. When powerful men lose money, they now want a government bailout. Does the Treasury Department or the various components of the FMOC have the authority to bail out Bitcoin?
Could you please elaborate? What exactly does bail out Bitcoin?
Okay,
mean,
could you
Congressman? That's a
instruct the
very-
banks of this country to buy Bitcoin, or change banking regulations so that they're encouraged to do so in terms of the reserves that they're otherwise required to have?
Again, that within the context of asset diversification within banks, they could hold many assets.
They can, and there are different, but do you have the authority to order banks to buy Bitcoin or to invest U.S. tax dollars in Bitcoin or Trump coin?
I am Secretary of the Treasury. I do not have the authority to do that. And as Chair of FSOC, I do not have that authority.
So we're not going to see our tax dollars invested in crypto assets.
Well, why would a private bank be your tax dollars, Congressman?
Excuse me, I'm now asking about the money of our taxpayers, which you manage as Secretary of the Treasury. Is it going to be deployed into crypto assets?
We are retaining seized Bitcoin.
That's not exactly taxpayer money. You collect a lot of taxes this month.
No, that is an asset of the U.S.
It's an asset of the
It is an
U.S.
asset of the
It
US
was
government. And
are you going to invest
and I will point out,
Mr. Secretary, reclaiming my time, are you going to invest?
from
the
California,
asset
stop.
seizure, that 1 billion of Bitcoin was seized, 500 million was retained, and that 500 million has become over 15 billion.
Gentleman's time has expired. The gentleman from Oklahoma, the chair of our Monetary Policy Task Force, Mr. Lucas, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Secretary, for being here today. You've said that the current deposit insurance framework is a vulnerability for the banking system, that there is a competitive imbalance that favors large banks, and that this increases the risk of bank runs and erodes depositor confidence. Can you talk more about a targeted expansion of deposit insurance for non-interest-bearing transaction accounts? And would that strengthen financial stability within the system?
Congressman Lucas, thank you for that very important question, because it is my belief, because there is the belief that big banks, the depositors, will not lose money. During a financial crisis, as we saw in 2023, assets leave small banks. And much of that is what is known as the payroll account. So I think it is very important for small banks to have one non-interest-bearing account that can have a much higher level of insurance so that they are able to retain deposits during a stress period. This is one of the reasons that we have seen assets leave small banks. It is one of the reasons that we have seen 50% of small banks disappear.
Continue along this line of inquiry, Mr. Secretary. A robust banking system with healthy banks of all sizes reduces systematic risk across the entire system. Why is it important that Congress act now on targeted deposit insurance reform, not only for Main Street, but also our financial stability?
Again, deposit volatility, which is what you're referring to, is deposits moving during a stress time, does not benefit anyone in the long run.
And one more question on this perspective. Congress should look at giving FDIC authority to raise the coverage level for non-interest bearing transaction accounts to an appropriate amount that is data-driven and put smaller institutions on a level playing field with larger banks. How would our banking system be safer with a narrow, targeted expansion, such as the one I've suggested?
Again, it would permit the small and community banks to continue competing. It would get credit to our main street, and it would stem deposit flight during a period of stress, which is one of the most or one of the biggest threats to financial stability.
Focusing on a slightly different subject. Sometimes something I've focused on as chairman of the task force on Treasury resilience has been strengthening market stability and liquidity. We saw occasional bouts of Treasury market volatility last year. How would reforms to banking regulations like the liquidity coverage ratio and stress tests incentivize market intermediation for banks and improve market stability?
Again, Congressman, wonderful question. That it brings more of our Treasury market onshore. And as you said, there were periods of stress last year. The market successfully navigated those. At the end of January, we had the third highest volume in the Treasury market, and the bid-ask spreads, very important for the financial well-being of the American people who are invested in money market funds, in bond funds, in their retirement funds. They have stayed right in the center line, and we are at a 5-year low in bond market volatility.
Thank you, Mr. Secretary. I yield back, Mr. Chairman. Thank you.
Gentleman yields back. Chair recognizes the gentleman from New York, ranking member of our Foreign Affairs Committee. Mr. Meeks, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Secretary Bessent, if I'm not mistaken, you were working in the financial service industry during the late 1980s, correct?
I was.
Thank you. And well, I'm wondering, do you recall or you're knowledgeable of the Keating 5 scandal back then?
Yes, sir. And I will point out that I was.
I don't want to.
No. I will point out that
Limited time. I have limited time.
I
The
identified.
gentleman is from,
time.
the Secretary is the gentleman
I
from
just
New
asked
York's
you a
time.
question. So I just want to make sure everyone knows who doesn't know that the Keating 5 scandal involved 5 U.S. senators accused of pressuring the Federal Home Loan Bank Board to expedite and give more consideration to the case of Charles Keating Jr., who ran the California-based Lincoln Savings and Loans. It led to a 14-month investigation unveiling how 5 U.S. senators and staff ended up with more than $1 million in contributions, 4 trips to the Bahamas, and all expenses paid stays at resort hotels. Following the scandal, the industry saw sweeping regulatory changes that was launched by then President George H.W. Bush. Now, Mr. Secretary, I'm sure you can agree conflicts of interest and improper influence by U.S. elected officials over bank regulators weaken supervisory independence and ultimately impose massive losses on consumers and taxpayers. I think that we can all agree upon that. And as we know, the basic lessons from the post-Keating reforms still applies today when the Office of the Comptroller of Currency, the OCC, is deciding to get a bank charter. I think we can stimulate that. Now, Mr. Bessent, as our nation's treasurer, I'm sure you also know that a foreign-linked investment firm tied to the United Arab Emirates government quietly bought about half of the Trump family's crypto company, World Liberty Financial. And at the very same time, the President of the United States was dealing with that country on foreign policy. Now, Eric Trump, the president's son and co-founder of World Liberty Financial, said, and I quote, "I'm not going to get into who the investors are, but I've got some pretty meaningful investors," end of quote. Lack of transparency. And it didn't end there. When Trump fans brought the tokens, they thought they were getting the deal of a century. But what they didn't know was that only Trump and his sons had the sole power to decide who can sell the token and when. Today, the price of the token has fallen over 50%, and the Trump fans who bought the token are now begging to get out. Now, I'm not making this up. I'm not making this up. You can see it for yourself on the World Liberty Financial Discussion Forum. Yeah, yourself, Mr. Secretary. So this is no longer just about a shady crypto deal or a possible gift when a foreign linked investor is putting hundreds of millions of dollars into a company controlled by the president's family, and at the same time, this president is conducting foreign policy with that country. You know what that creates? It creates a national security concern. So I'm not going to ask much of you, Mr. Secretary. I just want to know whether you will commit today to pause and heighten the scrutiny of any bank charter or licensing application at the OCC connected to the World Liberty Financial until all of these conflicts of interest and foreign influence reviews are completed and shared with the United States Congress. All I need to know is, will you halt it and do a complete investigation and scrutiny of this licensing application? All you have to ask is yes or no.
No, Congressman.
All you have to ask
the
is yes or
OCC is an independent entity, and I would know, Congressman.
So I take that as a no.
You traveled to Venezuela.
I take that as a no.
On behalf of
I take that as a no. You do not want to answer that question. I take that as a no.
For a $7 billion.
I'm asking you to do your responsibility as Secretary of the Treasury. You do not.
Mr. Meeks,
Will you?
time has expired.
You cannot erase what you did in
He's the one that went past your time, Mr. Chairman.
No, and the
He did not answer my question, and he
order,
wouldn't pass the
Mr.
time.
Meeks. He had 6 seconds left to try to answer your question, and the
It was a
time
yes or
expired.
no. It was a yes or no answer. I asked him, will he? No, it was
Gentlemen,
yes
the
or no.
chair recognizes
OCC
the
is an
gentleman.
independent
Stop
Mr.
covering
Bessent.
for the president.
Yeah, well,
Stop
Mr.
being his flunky.
yeah, and
Gentlemen.
He's talking to me. I'm responding
your
back to him.
2006 trip to Venezuela.
Neither
Why
one.
don't
Stop
why don't you
covering
tell
for
the
the president.
about
Don't be a
that?
flunky. Work for the American people.
Secretary, Mr. Meeks,
Trip to
Mr.
Venezuela.
Meeks,
Work for the American people.
And maybe
Don't
you're
be
going-
a
maybe you're
cover-up
going to-
for a mob.
Maybe you're going to
As
see your
long as
friend
he talks,
Nicholas
you talk.
I
Maduro
will.
in
gentleman is
Brooklyn
not
prison.
recognized. Mr. Bessent, please. I recognize the gentleman from Texas, Mr. Sessions. You're recognized for 5 minutes.
Mr. Chairman, thank you very much. Secretary, welcome to the Financial Services Committee. I'm delighted that you're here. Mr. Secretary, we've talked with you about a broad range of things, not necessarily related to FSOC and your chairmanship there, but I would like to, if I can, talk with you something about the word public confidence. And the word public confidence does have a lot to do with the financial stability of the country. There are reports in social media that have shown, and I don't want to put you in a position where you cannot answer this because of anything that you've learned in Minnesota with the $9 billion worth of fraud. But there are social media accounts that show people who are at a Minneapolis airport with baggage full of up to $1 million cash attempting to exit the country. And I have engaged several people who have worked at Treasury to ask their opinion about that. That not the relationship between how they got the money, but just that it's going out of the country and following the law. Can you tell us or give this committee your viewpoints about people not using some other system, but taking cash up to $1 million through our airports to leave the country?
Yes, so that is a DHS TSA function. We, having learned of this, we are attempting to integrate our FinCEN better with those forms. What we are trying to do at Treasury via FinCEN is to keep money from being wired out of the country through what are called money service businesses. So we have issued a geographic targeting order, bringing down the amount of reporting to $300, and also asking on the form, if someone is wiring money out of the country, are you receiving public benefits?
These are all very important issues. And as you did talk about, Department of Homeland Security does have a role in this. I would suggest to you that Treasury probably has a philosophy about the role of the American dollar in world economy, the stability that we have, the use of wanting to make sure that the dollar remains that dominant use. But I would tell you that I will be very interested if you have a working group on this, of us making ourselves aware, because it is an issue to people who simply see social media.
We look forward to working with you on that, Congressman.
Thank you, Secretary. Mr. Secretary, as you have alluded to, and as the discussion here has been about banks, community banks, the ability that they have, you recognize, because you spoke directly to it, about the stress that they are placed under as opposed to bigger banks. Could you please talk to us about what you believe the role is of home ownership, which is increasingly a part of the political discussion and debate and discussions for members of Congress back home, of solving our home ownership problem? And you've got almost a minute, boy, I'm giving you a lot of time, and interest rates as they correspond to people being able to buy their own homes.
Good, well, thank you. And I would note that I was also a banks and financial institutions analyst for 35 years and was instrumental in working with the government to bring down American Continental and Sun State Savings and Loans, which were the beneficiaries of the Keating Five. Getting small banks lending again, we need to get them back into the mortgage market. No one knows their communities like small banks. And that having moved into the larger system, the strength and breadth of the US mortgage market is choice. And we have lost the choice in the small banks. And I think we need to get them back into the housing lending business. And we're seeing, it's a tragedy that the average first-time home buyer is now 40 years old.
Well, I had a discussion last night with the realtors about their importance in this process too. So I'd like to once again make sure we see community banks and realtors and home builders all have an interest in
Gentleman's
this.
time is.
I want to thank the gentleman.
I thank the gentleman from Texas. Before we move on, I want to remind everyone participating today to uphold the House's rule of decorum. And I'd like to remind everybody to respect the 5-minute rule. And having been a witness before Congress before in my executive branch days, it is important to note that our members can spend their 5 minutes and never ask a question or not. It's their 5 minutes. So let's try to be mutually respectful of each other. And I now recognize the gentleman from Massachusetts, the ranking member of our Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, Mr. Lynch, Massachusetts, 5 minutes.
Thank you, Mr. Chairman. Mr. Secretary, based on early reports, and this is an analysis done by Public Citizen and subsequent news reports, when the Trump administration came into office, they immediately took steps to either halt, dismiss, or roll back over 100 enforcement actions and investigations against corporations in its first 2 months in office, with a very heavy concentration on financial services, consumer protection, and cryptocurrency, totaling over $3.1 billion in potential penalties avoided. Now, as a member of the Financial Services Oversight Council, is that a concern that you have raised within the council, all these immediate dismissals of cases against financial services firms?
Well, I think you're, the Biden administration had an extension.
Sir, please be responsive to my question.
I am.
I'm not-
I'm trying, sir, and this back and forth is just eating your time. That the Biden administration had an extinction policy for crypto.
This is
assets.
when Trump came into office. I'm going to go to the next question because your answers on, Mr. Chairman, the answers have to be responsive if we're going to have a serious hearing here.
Well, the questions have to be serious.
Well, those are 100 dismissals of cases that the Trump administration came in and executed in their first weeks in office, like that. All of a sudden, all these crypto cases went away. The SEC was dropping cases. The Consumer Financial Protection Bureau dropping cases. And
Well, sir,
look, you're on FSOC with all the heads of these agencies. This should be a serious question to you. Trust should be a serious question and a serious issue for the financial services industry, especially as the Secretary of the Treasury.
Well,
That's an important. No, this is my time. I haven't asked you any more questions. I haven't asked you any more questions,
It's the
sir.
gentleman from Massachusetts.
I'm trying to get to
time.
my next question.
Could you speak a little louder? I can't hear you.
Yeah, okay. I might.
Mr. Secretary, let Mr. Lynch proceed with his time. Put 4 seconds back on the clock, please.
Thank you, Mr. Chairman.
Yes, Mr. Lynch.
I just want to do a comparison of the FSOC reports. Let's go back to 2024, and then we'll talk about the current report. In the previous report, the members of FSOC expressed serious concerns related to potential risk to financial stability regarding the lack of explainability and high complexity of AI and the approaches that have a potential to heighten financial instability, especially in the areas of bias and discrimination in credit decisions. That was in 2024. Your report in 2025 focuses on removing regulatory impediments. So in 2024, we were concerned about consumer protections. And now, under your leadership, we're concerned with eliminating regulatory impediments. The dangers, and that was a report during a time where the chairman and I were co-chairs of an AI task force. Those dangers haven't gone away in reality. Those dangers are still as severe for the American consumer, but they are absent from FSOC's report. So it's obviously you've eliminated or dropped that priority as an issue for FSOC. So can you explain the change from protecting the consumer and now eliminating regulations?
We are charged with financial stability, and we are focused on leveraging AI strengthen the financial system resilience, but with economic growth and a security lens.
On the issue of explainability, any concern about that in the use of AI in the financial services industry?
I'm sorry, what was the question?
The issue of explainability, how when people apply for credit and are denied, we don't have the ability for AI to explain why they were denied. Is that a concern? I mean, we are talking about the trust within the financial services industry.
It could be a concern, but we don't view it as a priority for financial stability.
That's the truth. That's the truth. Okay, Mr. Chairman, I yield back. Thank you.
Gentleman from Massachusetts yields back. I recognize the gentlewoman from Missouri, Ms. Wagner, who chairs our Capital Markets Subcommittee. You're recognized for 5 minutes.
I thank you, Mr. Chairman, and Secretary Bessent. I find your answers to be quite clear, substantive, and as always, well informed. Thank you for being here. Early, sir, in your tenure as Treasury Secretary, you said, and you touched on it here today, and I quote, "For the last 4 decades, Wall Street has grown wealthier than ever before, and it can continue to grow and do well. But for the next 4 years, it's Main Street's turn. It's Main Street's turn to hire workers. It's Main Street's turn to drive investment. And it's Main Street's turn to restore the American dream." And as chair of the Capital Markets Committee, I could not agree more, sir. For too long, outdated securities laws have limited everyday Americans' ability to invest in innovative startups. At the same time, the number of companies listed on public markets continues to shrink. And as a result, everyday Americans in Missouri's 2nd congressional district that I have the honor to represent have fewer opportunities to invest toward major life goals, including owning a home, paying for their children's education, or securing a dignified retirement. Main Street businesses across the Midwest and other regions of our country are overlooked as venture funding and capital raising opportunities remain largely concentrated on the coast. That is why I have made it a priority to facilitate capital formation and empower entrepreneurs and small businesses across America. Just weeks ago, Mr. Secretary, December 11th to be exact, the House passed my Invest Act, a bipartisan package of 22 bills focused on 3 goals: expanding access to capital for small businesses, increasing opportunities for everyday investors, and strengthening our public markets. Capital formation is the lifeblood of American economic growth and prosperity. Our capital markets are indeed the deepest and most liquid in the world, and the Invest Act will ensure that they remain among the greatest strengths for decades to come. I look forward to continuing to work with you and the administration to advance these priorities and unleash the power of our capital markets. Secretary Bessent, in your view, what are the largest barriers to capital formation for a small business?
Congresswoman, I look forward to working with you. And I think I would bifurcate that. Most small businesses are individuals. And
Correct.
for many individuals, we have learned that most of them, 38% of Americans, do not own equities. So with the Trump accounts, which will give every child $1,000 seed finance, every American will be invested in a low-cost index fund. Every American will have a share of our great innovative economy. For small businesses, it is often, I would say, it is a duality of regulatory and access to finance. Americans are entrepreneurial. We want to get out and form businesses. And I believe that with the confidence of being able to do that, and what President Trump's agenda has done, businesses now have tax certainty with the One Big Beautiful Bill, that 100% deductibility of equipment, of factories, and of ag structures. We have energy certainty with our energy dominance, and we have regulatory certainty as we are pulling back the regulatory morass that was highly harmful to both small and large business.
Absolutely. And as global competition for capital intensifies, the United States risks falling behind if our public markets also, I must say, remain costly or inaccessible for growing companies. How important is capital formation reform, like the reforms included in the Invest Act? Again, 22 bipartisan bills that we brought to the floor with the support of 87 Democrats. How important are these reforms to maintaining U.S. economic leadership and long-term growth? Quickly, sir.
Congresswoman, they're vital. And what we have seen, as you correctly outlined, is since the early 2000s, the number of public companies available for Americans and indeed international investors to invest in has greatly diminished, and it has developed into a network of private assets.
Thank you. My time has expired. I have others that I will put forward for the record, and I yield back.
Gentlewoman yields back. Chair recognizes the gentleman from Texas, Mr. Green, who's the ranking member of our Oversight and Investigation Subcommittee. Mr. Green, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Secretary, I ask that you recall Liberation Day, the day that President Trump announced tariffs. I ask that you recall that when he made this announcement, there was a sharp decline in the stock market. In fact, when he made the announcement, the NASDAQ experienced a 6% decline the S&P 500 a decline of 11%. I ask that you also remember that some days later, the president announced that he was going to pause those tariffs. And when he indicated that he would pause the tariffs, the market then moved up. Do you recall these things, Mr. Secretary?
I recall them very well, Congressman.
Thank you. And I ask that you also recall, please, Mr. Secretary, that hours before the president announced the pause, he indicated by way of Truth Social, he has a more than 50% ownership in Truth Social. It's a great time to buy DJT. That was his announcement on Truth Social. And in so doing, Truth Social had a value that moved up. In fact, Truth Social, which the president has majority ownership, went up by $415 million. Now, here's what's interesting in this scenario. When he made that announcement and said it's a great time to buy DJT, that happens to be the symbol for his stock, DJT. I ask you kindly, and as one professional to another, Mr. Treasury Secretary, do you think that this should be investigated, the president's stock being linked to his Truth Social message, and that stock having gone up by some $415 million in a single day, and this is a stock that was doing very poorly prior to that, hadn't had a lot of success. Do you think that this should be investigated?
No, sir.
Kindly explain to me why we would not investigate the president making such an announcement as it relates to his stock and then reaping some $415 million as a potential capital.
Well, all Americans benefited from the rebound in the markets that day. And in fact, the rebound in the market after that was the fastest in market history.
Yes, it was. But here's what's interesting about your statement. You did not note, Mr. Secretary, that DJT had probably the sharpest increase on that day, 415 million, and that the president said buy DJT, and that's what happened.
I'm unfamiliar with the exact text. Did he say buy DJT?
Yes, sir.
Did he said
Yes, sir.
now is a good time to buy and have a salutation DJT.
Yes, sir. DJT immediately following, now is a good time to buy.
Well, those are his initials, as you said.
They are his initials, but it's also, do you agree that those are the symbol, that's the symbol for his stock?
I believe it is.
Okay. And do you believe that such a thing done openly and notoriously should not be investigated? Is that what you're telling the American people?
Sir, I believe that anything that is widely disseminated is widely disseminated and available to everyone.
Well, it was available to everyone, but what he said related to his stock could relate to something else, but to his stock. And here's the point, Mr. President, Secretary, here's the point. I believe that any other president making this kind of move is almost a hustle. I don't want to say that about the president, but making this kind of move would at least be investigated. If you're going to allow the president to do this openly and notoriously, $415 million, what you're doing is giving him a license to move markets at will, make announcements, and reap benefits. He is literally hustling the United States stock market. I yield back.
Gentleman's time is yield back. Gentleman from Kentucky, Mr. Barr, Chairman of our Financial Institutions Subcommittee, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Secretary, you came here to testify about financial stability and threats to financial stability. I think what we're learning from this hearing, Mr. Secretary, is how much Trump derangement syndrome is a threat to emotional stability. There's been a lot of lectures directed at you today. Would you like to clarify anything or respond in any way to any of these lectures?
I would just like to say that financial stability analysis centered on identifying vulnerabilities in financial institutions or markets that might disrupt the provision of credit or liquidity, disrupt other sectors, and lead to significant losses across the financial stability. This is what FSOC is chartered to do.
Thank you. Secretary Bessent, I'd like to applaud President Trump and the Treasury Department for announcing Trump accounts. I do believe this will kickstart the American dream for children born between 2025 and 2028 with a $1,000 investment from the U.S. Treasury. And I'm personally grateful because my daughter, Virginia, was born in October and will be a beneficiary of these Trump accounts. Not only will this ensure that American children born in this time frame will participate in the deepest, most liquid capital markets in the world, but it importantly will also teach this new generation about the power of compound interest and will help them develop financial literacy skills, which will make them owners and investors, and will improve their financial outcomes throughout their lives. Can you touch on the impact of these Trump accounts and how it will help this new generation achieve financial independence? And as you talk about that, we have a mayor of New York that espouses socialism, members of Congress who espouse socialism. How will these Trump accounts impact this new generation of Americans' view of financial independence versus socialism?
Again, history would show that people who own a piece of the action do not want to bring down the system when you are part of the system. As I said, 38% of American households, they do not participate in the equity market. Many do, many directly, many through 401ks. But over time, the goal here should be to have everyone own a piece of the American economic engine. We at Treasury, working with many people, are going to work on financial literacy. This will be one of the greatest real-time experiments in history. You are bringing Wall Street to Main Street, and Wall Street will work for Main Street instead of the other way around.
Well, on behalf of my 3-month-old daughter, Virginia, and millions of American children, thank you to you and President Trump for bringing financial independence to the American people. I agree with you that economic stagnation is itself a threat to financial stability. That's why we're pushing this Main Street Access to Capital bill, which will provide for more de novo charters of community banks, the TIER Act, the Community Bank Regulatory Tailoring Act, which would modernize these statutory thresholds to remove the static nature of the thresholds and allow for more diversity and growth in financial institutions. Can you discuss how indexing these static regulatory thresholds will allow banks of all sizes to grow, and how that will in turn help financial stability?
Yep. So, Congressman, I've said very often that under the regulatory straitjacket that emerged that pushed lending outside the traditional banking system, small banks became too small to succeed. And I think we have to fix that and tailor it to the risk for people who know their communities, who are concentrated geographically. And if you were in Iowa, you were concentrated in farming. If you were in Florida, you were likely concentrated in real estate and tourism, and we need to make adjustments.
And that will promote diversity in the financial system, which in turn will help with financial stability. Final question, Secretary Bessent. At the end of last year, President Trump signed into law the NDAA, which included my legislation, which will be overseen by the Treasury Department, the Comprehensive Outbound Investment National Security Act, also known as the Fight China Act. The COINS Act will ensure that Americans are not unknowingly funding the military-industrial complex of our adversaries by codifying and enhancing the Trump administration's existing outbound investment security program. Can you discuss the Treasury Department's new obligations under this bill, and how do you intend to implement it to prevent capital flows into Chinese military-industrial complex companies?
Well, I want to thank you for this important piece of legislation. It is another arrow in our quiver, and I can tell you, as I am the lead negotiator with China on the economic front, it is very useful for me to be able to say, well, I'm happy to refer things to the Hill.
Gentleman's time has expired.
Great to work with you on that. I yield back.
Gentleman's time has expired, and I recognize the ranking member of our Housing and Insurance Subcommittee, Mr. Cleaver of Missouri. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Unfortunately, this is an embarrassing kind of a hearing. I've been on this committee 21 years. We've had all kinds of conflict. In fact, I was in here when the Federal Reserve Chair, along with the Treasury Secretary, and many others came in to tell us what was going to happen if the Asian markets, when the Asian markets opened after the collapse of the economics of our nation. And I've learned that you can't make honey and sting at the same time. The question is whether we came here today to sting or whether we came here to talk about issues that are of importance to the nation. I got a little grandson, I hope. Well, he was in school today. I would hate for him to have seen this so far. What I would like to talk about is your opinion of the dual mandate, stable prices, maximum employment. I would like to get your philosophy on that issue. Is that the creators of the Federal Reserve, and then the mandate, was that a mistake?
The Federal Reserve Act of 1913, which created the Fed, and then we have morphed into the dual mandate, and the dual mandate is a very delicate balance between maximizing economic growth while maintaining the low levels of inflation.
Well, so then you believe in, I'm assuming, the independence of the Federal Reserve.
I believe in the independence of the Federal Reserve, but I also believe in accountability.
I mean, can you explain how you put those two together?
Sure, I would welcome, we've seen these cost overruns at the Fed. The Fed has the independence of the Fed is based on its trust with the American people. And the Federal Reserve lost the trust of American people when it allowed the greatest inflation of 49 years to ravage working people in this country.
Mr. Secretary, so the people in the country, there was a poll or something? I mean,
subscribe, like, follow, and share. Sige na please, Kamiranda.